I'm Mr. Nuts. And this is Cocoverse. It's that one place in the metaverse where you can't work for peanuts, because in Cocoverse, peanuts don't exist. And the only reason why I exist is to help you learn all the skills you need to run an online business regardless of where you live. This is the first part of my series Business 101, a series of episodes that walk you through how normal businesses are set up correctly and operated efficiently, so that you can maximize your profit. You deserve it. It's called business administration. Yeah, the part of running a business that many people ignore. And they lose a lot of money because of it. This happens often to digital nomads, freelancers, solopreneurs, part-time consultants, and those who run a side hustle. I tell you why. Because they don't treat their efforts to earn money as a real business. I give you an example. Let's say you're a freelance designer, writer, or software developer, and you just made your first $10,000. Nice, right? Now, you want a new laptop, since you have the money. So, you go buy yourself one, worth $2,000. You go to a computer shop, pull the money from your bank account, make the payment, and you're done. But here's where things go wrong. If you don't record buying that laptop as a business expense, you're telling the tax man that you made $10,000 in profit. Which means you'll get taxed on the full 10 grand. In reality, since you need the laptop for your work, your actual profit was only $8,000. Those $2,000 went toward a legitimate business expense. So, you're paying tax on $10,000 instead of paying tax on $8,000. Depending on your tax rate, that could easily be an extra few $100s gone. Let's say your income tax is 25%. On an income of $10,000, 25% is $2,500. You're left with $7,500 after tax. But if you can deduct the cost of your laptop, that $2,000, as a business expense, your taxable income is only $8,000. And then, a 25% tax on that is only $2,000. You're left with $8,000 instead of $7,500. See the difference? You'll save $500. You lose $500 because you didn't care to do your books right. And the laptop is only one type of expense. Multiply that by software subscriptions, web hosting, co-working space rental, and travel to meet your client, and suddenly, you've overpaid thousands of dollars before you realize. So, what you need to understand is this. Your personal finances and business are not the same thing. Even if you're a freelancer, they're separate things. If you mix them together, your books get messy, and you can't see your real profit. This means you can't plan for taxes correctly, either. So, you'll end up paying too much. By the way, this is my little brother. Do you have something to add? Well said, thank you. Moving on. Here's how to do it right. 1. Get a separate bank account for business use only. This way, your bank statements show exactly how much money you're making. 2. Track your income and expenses separately. A simple spreadsheet will do just fine. Income minus expenses equals profit. Profit is what you want to be taxed on, not your overall income, which is called revenue. 3. Keep receipts or digital records of every business purchase. Remember to scan or take a photo, because paper receipts are not made to last for years. 4. Categorize your expenses into things like software, marketing, and so on, to know exactly where all your money goes. Then, you can optimize your expenses quite easily. At the end of the day, not doing your books properly is like working for free. You're literally throwing away some of your hard-earned money. By recording everything business-related as an expense, you save money from your after-tax baseline. So, never skip bookkeeping. You don't even have to become a chartered accountant. But you must learn to do your business administration tasks right, and thus, optimize your baseline. But what do I know? I'm just a monotonous, uninspiring AI voice trapped inside a coconut. One more thing, and this is an important part. While bookkeeping is standard practice everywhere, each country has slightly different rules about how to do it and what counts as a business expense. In many countries, you have to register a company first, and get a business license to operate it. Like any other real business. Next time, I'll show what typical company types exist, so that you start counting your revenue and business expenses correctly, running a real business, and make more profit. See you soon again in Cocoverse. This is the second part of my series Business 101, a series of episodes that walk you through how businesses are set up correctly and operated efficiently, so that you can keep all your hard-earned money, i.e., make a nice profit. You should do it right from the start. Unfortunately, many don't. This happens often to freelancers, solopreneurs, digital nomads, part-time consultants, and people who run a side hustle. That's because they don't treat their efforts to earn money as a real business. One particularly tough issue is the lack of a company structure. As I showed in the previous episode, you should be able to deduct all your business-related expenses from your revenue to calculate the profit. Profit is what you want to be taxed on as a business, not your overall income. Many people lose a lot of money when doing it wrong for years and years. Today, I'll walk you through typical company structures. While every country has different legislation, there are similarities and commonalities across almost all countries. In general, there are 6 main company types: private limited corporation, partnership, cooperative, limited liability company, sole proprietorship, and nonprofit. When you run a one-person business, you can exclude private limited corporation from the picture, as it's designed to accommodate multiple shareholders or aim to be publicly traded on the stock market. You don't aim for either of those goals. You can also exclude partnership and cooperative companies, since you don't have anyone else involved in your one-person business. That should be fairly obvious. You're definitely not a nonprofit that has no shareholders, either. So, you're left with limited liability company and sole proprietorship being realistic options. I tell you what the differences are and why they're relevant to you. A sole proprietorship is the quickest and easiest way to start a business. Something similar exists in almost every country. Basically, you wake up and say, "I'm open," and you are. Minimal or no paperwork, minimal or no fees. You might need to visit the company registry of your country and perhaps get a business license. This setup usually costs peanuts only. Taxes stay really simple, too, because your business and personal money are treated the same. You are a sole proprietor, meaning the only owner. With this structure, you can deduct all your business expenses from your revenue and easily count your profit that you will be taxed on as an individual. Limited Liability Company, LLC, takes a bit more effort and usually costs money to set up, but you get limited legal liability, as the name suggests. This means that your business is a separate legal entity, so your personal finances are protected. Many freelancers start as sole proprietors, then switch to an LLC once things get serious. By the way, this is my father. You can see that the coconut doesn't fall far from the tree. But we might roll a little bit. Moving on. There is one big difference between sole proprietorships and limited liability companies. Legal liability. If you end up in legal trouble, be it because of a mistake you made with contracts, for example, or you just ran into a client who screwed up big time and decides to make someone else pay just to save himself. These cases happen sometimes. Anyway, if you have a sole proprietor company, since the company is not a separate legal entity, your house, your car, your fancy laptop, and every asset you own could be taken from you and sold to cover the client's damages after you lose a nasty lawsuit. However, if you form an LLC, you have an extra layer of protection. The LLC is a separate legal entity with you as its director. In case of a lawsuit, it's only the LLC that takes a hit. Everything the LLC officially owns according to its books could be gone. But your personal assets, like your house or car, are not. This is why many freelancers, solopreneurs, and digital nomads often start as sole proprietors to test the waters, then switch to an LLC once things get serious, just to make sure their personal finances and assets are protected in case of trouble. Remember, the company types differ from country to country. You must find out what options you have available and what rules and fees apply. Next time, I'll show one of the best moves you could ever make. Set up a single-member LLC in the United States, which offers multiple benefits, especially if you're moving or traveling often. Anyone can do it. And the best part, it can be operated fully remotely. See you soon again in Cocoverse. We've reached the third part of my series Business 101, a series of episodes that teach you how businesses are set up correctly, operated efficiently, and made profitable. Unfortunately, many solopreneurs, freelancers, digital nomads don't get it right from the start. They lose some money. As I mentioned last time, having a company structure is essential for long-term success. And what's better than having a company in the United States? You can have a fancy United States business address, an American bank account handy for domestic transfers, and potentially huge taxation benefits. Today, I'll show you why registering a company in the United States is a great idea, especially if you're not a United States citizen or resident. It may sound counterintuitive, but it works perfectly. One particular type of company is 1. Inexpensive to set up and maintain. 2. Easy to get started. 3. Not taxed by the federal laws if owned by a non-resident, non-citizen. The last part is particularly sweet, right? I'm talking about a single-member LLC registered in Delaware. It's a type of limited liability company that can be owned by a foreigner. And it can be registered remotely from your home. It's absolutely perfect for freelancers and solopreneurs, and for digital nomads who change countries like shirts. It's a structure that offers a powerful combination of corporate-level legal protection and predictability of fees involved. The initial step to get the company registered. The state filing fee is only $110. That enables your business to be officially established as a legal entity in Delaware. And as I explained before about LLC companies, you get an American legal entity for your business, which is not you as a legal person. This means that if any legal disaster arises for any reason, you can just close your company and start over. Your personal assets and money won't be affected. Next, the best part: taxes. While many other states require complicated annual reports and fees tied to revenue or complex valuation formulas, Delaware LLCs demand only one thing: the payment of a $300 flat annual franchise tax. Compared to almost any other company type on this planet, Delaware LLC is unique. It's very affordable to maintain. Whether the LLC generates $1,000 or $1 billion in revenue, the annual fee remains $300. Easy to budget. So, you only have two main fees. 1. Initial filing, a modest $110 fee for the registration. 2. Annual compliance, a $300 flat annual franchise tax. By the way, this is my mother. My mother is my root, my foundation. Literally, in my case. Moving on. Now, you probably wonder, if my business is in the United States, do I need to pay income tax in America, too? You might not believe it, but you only pay your income tax in the country you live in. You see, a foreign-owned single-member LLC is a concept of a disregarded entity under United States tax law. This is a special type of pass-through entity where the American Tax Authority, IRS, ignores the LLC as a separate taxable entity from its owner for federal income tax purposes. The LLC's financial activities are treated as if the foreign owner personally conducted them. This means the LLC itself does not pay United States federal income tax, thus avoiding double taxation at the corporate level and again at the owner's level. This is absolutely beautiful. However, there are reporting requirements. This is just two forms filed annually. Form 5472 and a pro forma Form 1120 to report transactions between the LLC and its foreign owner. You only report how much money you put into the company and how much you took out. Failure to file these numbers, even if no tax is due, results in steep penalties, starting at $25,000 per missing form. You don't want to miss that. In practice, it's best to find a small agency that files those forms for you. This can be done for less than $100. And lastly, the funniest part. Some countries treat foreign-based income differently from local businesses. So, right after finishing this episode, go to your tax office, queue up, and the tax officer will be happy to tell you how income tax works in your case. While it costs some money to maintain, having a Delaware LLC can be highly profitable for non-American freelancers, solopreneurs, and especially digital nomads. Anyone can calculate this. But remember, double-check everything. What I just told you is how things work in 2025. Things may have changed since then if you're seeing this episode later. For instance, the fees might have gone up. Next time, I'll show you exactly what steps you need to take to register a single-member LLC in Delaware. It's not hard. Anyone can do it. So, see you soon again in Cocoverse. This is the fourth part of my series Business 101. I'm showing you how to run businesses correctly and efficiently, so that you can make as much profit as possible. Many freelancers, digital nomads, and solopreneurs ignore the importance of their business setup, and thus, lose a lot of money. As I told you last time, a single-member LLC is probably the best choice for people who like to travel while working. And you should do it in the state of Delaware, United States. As you already know the benefits, let's look at the exact steps you need to take to get your business started in Delaware. First, you have to register your company. This can be done easily through this website, firstbase.io. It's a company that acts as your registered agent, and it gives you a registered business address and a mailbox service. You are required to have an agent and a mailbox by law. Currently, they offer the complete setup for a one-time fee of $399, which is absolutely peanuts compared to what you get. First, they register your company. To get that done, all you need is to sign up, describe your intended business, and make the payment. They handle everything. A couple of days later, they send you a scanned copy of the certificate of formation document. It comes with a file number that you need for tax purposes later. The registration fee is covered in the price you already paid First Base. You also get the operating agreement automatically. No worries there. It's just a standard template with the name of your business on it. If you thought you'd need to put a lot of effort into registering your company, no worries there either. Form SS4 required to get your EIN is filed on your behalf by First Base. Form 8821 is filed for you as well. You do not do any paperwork. That's the beauty of this service. It doesn't end there. Then, you just wait a week or two, and your EIN letter is sent to you. Now, with your EIN, you can open a US bank account for your business. Guess what? That too is done for you. The only thing is that opening a bank account can take 2 to 6 weeks, but during that time, you don't need to do anything at all. When you get your bank account, put a couple of $100s there to get started. Then, go to delaware.gov to see if you need a business license. This is not done by First Base, remember that. Finally, you must submit the FinCEN BOI within 90 days to report the beneficial owner of your company. To do this, go to fincen.gov/BOI where you can find instructions for submitting it. You get this kind of receipt for submitting the report. You now have a single-member LLC in Delaware, perfectly in order for what comes to paperwork. And you didn't need to do much at all. It took about a month of calendar time, that's all. It's so easy that literally anyone can do it. By the way, this is my sister. A sister is both your mirror and your opposite. In my case, though, she looks exactly like me. Moving on. The last thing is to find someone to do your books in case you don't want to do them yourself, and someone qualified to file your taxes. Remember, as a foreigner and a non-resident, you don't need to pay income tax in the United States with this kind of single-member LLC setup. But you still need to file it. You must file Form 5472 and a pro forma Form 1120 before April 15th each year. I recommend you hire a pro to do it for you. It can be a small agency, for instance, that is easy to find if you search a little. You can even find those on freelance sites quite easily, and they can do your filing, and sometimes even submit the FinCEN BOI report for you too, for less than $100. But remember to get someone qualified. Failure to file these numbers, even if no tax is due, results in heavy fines, starting at $25,000 per missing form. Finally, the franchise tax. You can make the payment yourself at delaware.gov. Remember to do that in May every year, before June 1st. For your type of company, you do not need to file any annual report. The remaining fees include renewing your First Base subscription annually for the registered agent service and the mailing service. It's a couple of $100 each. The fees or deadlines may have changed if you're seeing this episode later. If you want to set up this kind of business for yourself now or a bit later, I have good news for you. Go to cocoverse.lol, where you'll find affiliate links that give you a nice discount on company registration. Just scroll down the page to the affiliate links section. Next time, I'll show you what options you have for getting your money out of your company. And no, a simple withdrawal isn't the only way. So, see you soon again in Cocoverse. In the fifth part of my series Business 101, I show you how you can withdraw your profits correctly without wasting any money or paying excessive taxes. Many freelancers, digital nomads, and solopreneurs only know one way of paying themselves. Just making a transfer to your personal account and that's it. But that is not the only way. There are a couple of ways. Some business owners pay themselves a salary just like employees. While this is a simple way to do it, the burden comes from managing a payroll even for yourself. This is why many take dividends on a regular basis. For example, every quarter. Dividends are handy when you make a profit irregularly, sometimes more, sometimes less. This way, you never get stuck with paying yourself a regular salary. Very handy. However, to pay yourself dividends, you must have the right company structure. The single member LLC that I keep telling you about does not support dividends. No can do. By default, a single member LLC is treated as a disregarded entity for federal tax purposes. That means the IRS sees no separation between you and the business when it comes to income taxes. So, instead of receiving payroll or dividends, you take an owner's draw. An owner's draw is simply this: transferring money from your LLC bank account into your personal bank account. That's it. There is no payroll tax withholding, no W-2, and no corporate dividend. It counts as your personal income, since you run a single-member LLC. By the way, this is my grandma. Grandmothers always have time to talk and make you feel like a special coconut. Moving on. There's no IRS rule limiting how often you take money out. You can transfer funds weekly, pay yourself monthly, or take irregular withdrawals only when needed. And no payroll. Your draw is not a business expense. It does not reduce your business profit, which you will be taxed on an individual level. Your owner's draws are your taxable income. Now, this gets pretty funky when you are a non-American living outside the United States. All you need to do is declare your owner's draws as your income. Really simple and efficient. And as I mentioned earlier, some countries have different rules for foreign-based income. Go check how this works in your country, and start making crazy profits. Even though the IRS ignores the LLC for income tax, it does not ignore your bookkeeping. So, for compliance purposes, count every dollar and every cent, and put them into these two categories. You have to get this right by the cent from the start. Otherwise, you get into trouble with the tax authorities in the US. And probably in your country of residence too. And lastly, make sure you do not make these typical mistakes. Never pay personal expenses directly from the business account. This is one of the biggest mistakes LLC owners make. If you buy clothing or other non-business items with the LLC card, you mix personal and business funds. Huge mess. Never call owner's draws salary or payroll. Calling owner's draws as salary is incorrect and can cause payroll tax filing problems. And lastly, never think of the draws as expenses that reduce your taxable income. Get this wrong, and you end up being sued for tax evasion. Probably not worth risking it. And one more thing. Remember to save some of the money for your income tax. Spending all your profits is the surest way to get a panic attack when the day to pay your personal taxes comes. Actually, there's one way how rich people never pay income tax. They don't take any money from their businesses. They take a loan instead, and use their assets as collateral. Well, this might not apply to you, but it's a fun trick to be aware of. Or maybe you are the next multi-millionaire in the making. If you wish to incorporate a company and run it remotely, go to cocoverse.lol, where you'll find affiliate links that give you a nice discount on company registration with First Base. Just scroll down the page to the affiliate links section. Next time, we start a new series on how doing business actually works. So, see you soon again in Cocoverse. Now, back to bed.